Good morning, students. Welcome you all once again in the live virtual classes organized by Board of Studies of ICAI. Friends, today we are going to start two standards and we will be completing two standards, Ind AS 8 and Ind AS 10. So right now we are discussing Ind AS 8. Ind AS 8 is on accounting policies, changes in accounting estimates and correction of errors. Now, what is the agenda of this standard? So in our accounting standard, first of all, let me talk more about the accounting standard also. So in our AS context, we have AS5. Do you remember AS5? We have AS5, which talks about this accounting policy concept. Yes. So then, and largely, this disclosure of accounting policy is governed by AS1, right? And this AS5 talks about net profit before, net profit after prior period items, and this 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 AS5 covers all those kind of items. Okay. So if I compare this Ind AS 8 with our accounting standards, so it is largely a mix of AS1 and AS5. Okay. But still, the kind of detailed guidance given in Ind AS 8, those kind of detailed guidance are not available in AS1 and AS5. Okay. So globally it is IAS 8, International Accounting Standard 8, and in Indian context it is Ind AS 8. So we are discussing Ind AS 8. Okay. Now, talking about this Ind AS 8, like every standard, we'll quickly touch upon the objective and scope, right? Then we'll discuss. So as the name suggests, this standard has three elements. This standard has accounting policy element, accounting policy. This standard has accounting estimate element, okay? And this standard has a error element. When I say error, correction of error, okay? So this standard revolves around these three big ticket items: accounting policy, accounting estimate, and correction of errors. If I talk about the weightage of this standard, in terms of these three items, 50% of the standard talks about accounting policy and remaining 50% covers these two items, okay, accounting estimate and correction of errors. Now, when I talk about accounting policy, this standard explains how to select and apply an accounting policy, right? If you have to form an accounting policy, how to select and how to apply an accounting policy. This standard talks about the selection of accounting policy and the application of accounting policy, right? So you all are aware, in the notes to accounts, one of the major component is accounting policy. What is accounting policy? Accounting policy is something. Accounting policy is a policy on which accounting is required to be done. Right? So you all have seen the accounting policy of any company. You must have drafted accounting policy, you must have audited accounting policy, you must have read accounting policy, right? So accounting policy is one of the important section of the notes to accounts. Yes. So Manoj has confirmed, yes, he has seen, drafted, audited accounting policy. What about Charita, Sai Kiran and Ravinder? You can also write on the chat box, just confirming. Yes. So accounting policy talks about the accounting, recognition, measurement, okay, presentation sometimes. So then after discussing the selection and application, this standard also prescribes changes in accounting policy. When this standard prescribes changes in accounting policy, it suggests when to change an accounting policy, when to change, in which circumstances accounting policy change is required, in which circumstances, okay? Then this standard also says, right, when a change is not considered as a change in accounting policy. There is a change, but this change is not considered as a change in accounting policy, right? This change is not considered as a change in accounting policy. So what is the benefit? What is the benefit if somebody will say that this change is not a change in accounting policy? What is the benefit of that? Anyone who can tell me? You guys have covered Ind AS 1, right? I have explained Ind AS 1, and in Ind AS 1 I have explained the third balance sheet. Are you aware about the third balance sheet? What is the third balance sheet? Opening of the comparative period balance sheet. For example, current year is 25-26. What is my balance sheet date? 31st March 26. Then what is my comparative period? 24, 25. Then comparative balance sheet date is 31st March 25. What is the opening date of the comparative? 1st April 2024. This is known as a third balance sheet, which is opening of the comparative balance sheet. And what I told you? So I told you that in case of change in accounting policy, which is applied retrospectively, in case of change in accounting policy, in case of correction of prior period errors, we have to draft, we have to give third balance sheet, right? And we have to give so much of disclosures. So whenever a change is concluded as a change in accounting policies, then you have to give third balance sheet, you have to give some reconciliation, you have to give some additional disclosure. Lot of work has to be required to be done. But my dear friends, if the change is not considered as a change in accounting policy, then nothing is required, right? Whatever change you are doing, it has to be done prospectively in the current year itself. Okay. Have you understood this or not understood? Application of a change in accounting policy. So first we discussed when to change. We discussed means the agenda. When to change. Then we discussed when a change will not considered as a change. Then we discussed application of a change, right? So these three changes we will cover. These three changes we will cover in terms of changes in accounting policy. Then we talk about change in accounting estimate, correction of error, and we quickly touch upon difference between Ind AS and ICAI. Okay, sounds good. Let's move into the journey of Ind AS 8, accounting policies, changes in accounting estimate, and correction of errors. My dear friends, accounting policies. What is meant by accounting policies? Yes. And tell me whether your balance sheet has some items, for example, property, plant and equipment, intangible asset, provision for gratuity, provision for leave encashment, provision for warranty obligation, right? Investment, bank balance. So many items are there in the balance sheet. Now, whether every item in the balance sheet is an accurate item, I mean to say, whether every item balance sheet is carrying an accurate amount, or few items in the balance sheet is also carrying a best estimated amount. Whether your balance sheet is full of accurate amount, or in your balance sheet few items are carrying the best estimate amount. Yes, balance sheet is mix of accurate number and the best estimate, right? So balance sheet is mix of accurate number and the best estimate. Okay, you are absolutely right. Now tell me whether your property, plant and equipment balance in the balance sheet, is it a best estimated amount or is it a accurate amount? Manoj is saying PP best estimate. Okay. So Ravinder is saying best estimate. Saminathan is saying best estimate. Ravinder has explained also. Ravinder has explained it is best estimate due to depreciation. You're absolutely right. In your balance sheet, net block of PP comes in the balance sheet. And the net block means gross block minus accumulated depreciation minus accumulated impairment loss, right? If impairment loss is not there, that is okay. But what is the formula of the carrying amount of PP, intangible asset, investment property? As per the respective standard, the formula is gross block minus accumulated depreciation minus accumulated impairment losses. Now, what is your depreciation and impairment loss? Is it something which is accurate? Your depreciation is based on the useful life. What is the definition of useful life? Useful life is an estimated life, right? Can you estimate the human's life? Sorry, I mean to say, can you say that that Mr. Garg, you will live for 70 years? Can you say that? No, no, you cannot say with the conviction. You can only say, you can only say with that the best estimate, sir, likelihood that you will live for 60, 65 years, for example, right? So it is an estimate. It is an estimate, right? It is a best estimate. Okay. it is not an accurate amount. Useful life of fixed asset is the best estimate. Like telecom company, tower company, depreciate towers on the life of 20 years. So what happens? After 20 years, all the towers fell down. Yeah. So there was a tower which is lying on the rooftop. So just when 20 years complete, the next day morning, all the towers fell down. Of course, no. Of course, no. So it's a best estimate. So friends, your balance sheet includes your accurate amount as well as a best estimate also. So that is why it is important to understand estimate. It is important to define a policy so that the user will be able to understand what is the accounting policy of this item, right? And you must have seen for all the material item in the balance sheet in your annual report, you have seen they have given the accounting policy of the line item of the every item. For example, if I'll show you the ONGC annual report, friends, I hope ONGC annual report is visible to all of you. Is it visible or not visible to all of you? This is the ONGC Limited annual report. If you see the ONGC Limited annual report, you can see they have given the accounting policies, and in the accounting policies, they have given the accounting policy of investment in subsidiary, associate, and joint ventures. They have given the accounting policy of, if I talk about the accounting policy, they have given the accounting policy of non-current assets held for sale. They have given the accounting policy interest in joint operations, right? And they define what is joint operation, how the accounting has to happen. Government grant, they define government grant, right? So government grants are not recognized, recognition principle they have given until there is a reasonable assurance that the company will comply with the condition attached to them and that the grant will be received. So first of all, they have given the recognition condition. Then they have told monetary government grant whose primary condition is that the company should purchase, construct, or otherwise acquire non-current asset, and the grants are recognized and disclosed as deferred income under non-current liability in the balance sheet and transferred to the statement of P&L on a systematic and rational basis over the useful life of the related asset. All non-monetary grants received are recognized for both assets and grants at nominal value. What they did, they have given the recognition, measurement, presentation, disclosure of government grant. PP&E, then they have given the accounting policy of PP&E. They have given the useful life of PP&E. Okay. So what they are giving for every material line item, they are giving the recognition, measurement, presentation, disclosure principle, right? Principle of those items. That is known as accounting policy. What is an accounting policy? These are the specific principle, basis, convention, specific principle, basis, conventions, rules and practices applied by an entity in preparation and presentation of financial statement, right? Accounting policies are a specific principle, basis, convention, rules and practices applied by an entity in preparation and presentation of financial statement. For example, I am saying that PPE is depreciated over the useful life of the asset. PPE is depreciated over the useful life of the asset. What this statement reflects? What this statement reflects when I'm saying PP is depreciated over the useful life of the fixed asset? Don't you think this statement reflects some principle, practice, basis, rule, right? I'm talking about a rule. PP is depreciated over the useful life of the fixed asset, right? So what this statement reflects? This statement reflects an accounting policy. Yes or no? Yes or no? Whether this statement reflects accounting policy or not? Yes, this statement reflects accounting policy. Now, within the accounting policy, when I'm saying PP is depreciated over the useful life of the asset, what is useful life? What is useful life? Useful life is an estimate, right? Useful life is an estimate. Useful life is an estimate, right? So PP is impaired. PP is impaired when the recoverable amount is lower than the carrying amount. What this statement reflect? I am saying as an authority that PP is impaired when recoverable amount is lower than the carrying value. So this reflects the principle, basis, practice, rule. Okay, what is this statement? This statement is a policy. But my dear friend, what is recoverable amount? What is recoverable amount? How do you estimate recoverable amount? It's not an accurate amount. Recoverable amount is an estimate, right? You must have read in accounting standard 28, or going forward you will read in Ind AS 36 Recoverable amount is higher of fair value less cost to sell and value in use. Fair value less cost to sell is also an estimate. Value in use is also an estimate, right? And higher of these two estimates will also an estimate. So recoverable amount is also an estimate. Friends, have you understood the difference between an accounting policy and estimate? So how to do it? How to do it? Right? So what to do it? What to do it? What to do is an policy. How to do is an estimate, right? So how to do means, for example, depreciate over the useful life. Okay. How to charge the depreciation over the useful life. Okay. But what to do? Depreciate, right? Depreciation over the useful life. But how? So first, what to do is depreciate. But how? Over the useful life. Okay. Is that clear? Right? So depreciation is an estimate, fair value is an estimate, recoverable amount is an estimate. Okay. Friends, is that clear? This simple definition: accounting policy are specific principle, basis, convention, rules, and practices applied by an entity in preparation and presentation of the financial statement. Okay. Example: PP is initially measured at cost, subsequently PP is measured at cost or revaluation model. PP is depreciated over the useful life of the fixed asset. Okay. Yes. Great. Now, selection and application of accounting policies, very, 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 very important. For example, Ravinder. Ravinder is a chartered accountant. He joined a company. After qualifying a chartered accountant, he joined a company. And since Ravinder scored 95 marks in financial reporting paper, okay, so and his CFO, his manager knows that Ravinder is a top scorer in financial reporting subject. So Ravinder joined financial reporting vertical, the balance sheet vertical of that company. His manager told Ravinder, can you please draft an accounting policy on intangible asset? First time we have implemented SAP and we spent 5 crore rupees. Can you please draft an accounting policy on SAP implementation on this SAP software, on this intangible asset? So when I say accounting policy means how to recognize, how to measure, how to recognize, how to measure, when to measure, okay? How to recognize, how to measure, when to measure. So where to present, what about the a subsequent measurement, what about the revaluation model, what about the cost model, right? What about amortization, what about impairment? Can you please can you please draft an accounting policy on that? So now, Ravinder, you have to draft an accounting policy. How will you draft an accounting policy? From where you can get the guidance? For drafting an accounting policy, you need accounting standard, right? आपको वैसे ही करनी पड़ेगी ना, अकाउंटिंग स्टैंडर्ड से ड्राफ्ट करोगे ना, बट कहां से गाइडेंस लोगे? So Ravinder, from where you will get the guidance? If you have to draft an accounting policy on intangible asset, you need to see. You need to see first. First, you need to see. First, identify and use the appropriate index which deals especially with the transaction event or situation. So Ravinder will find out whether any standard exists relating to intangible asset. He scored 95 marks. He remember, oh yes, Ind AS 38 exists. Ind AS 38 exists which deals with the accounting for intangible assets. Yes. So Ravinder quickly, while Ravinder remember that standard, but he quickly opened the standard and he find out what is the initial recognition condition, what is the initial measurement condition, what is the subsequent measurement, cost model, revaluation model, amortization, finite life, infinite life, revaluation. Okay. So he then presentation, then disclosure. He went through the standard and drafted an accounting policy, right? Manoj, clear? Saminathan, is that okay? So you refer the respective specific accounting standard, I mean to say Ind AS, and you draft an accounting policy using that specific Ind AS on that specific item, right? Yes? Okay. So now, very quickly, Ravinder refers Ind AS 38 and Ravinder drafted an accounting policy on intangible asset. But Ravinder, tell me one thing, what happened? So here, the specific Ind AS was available. But Ravinder, had the specific Ind AS not available, then what will you do? You have to draft an accounting policy. If there is a transaction, accounting has to happen. क्या करोगे? If there is no specific accounting policy, then what is the resort? Manoj, what should we do? If there is no accounting policy, if there is no accounting specific accounting standard, Manish, what should we do? Saminathan, what should we do? If there is no specific Ind AS dealing with that item. Ravinder is saying I refer Ind AS 1. No, Ravinder, Ind AS 1 will never tell you the accounting. Ind AS 1 is on presentation of financial statement. Ind AS 1 does not cover the accounting. AS1, Manoj, AS1, why in Ind AS you will refer accounting standard 1? So Manish is saying, just a minute. Saminathan is saying we have seen any similar Ind AS there. You are absolutely right, Saminathan. Yes. So best judgment use, Manish is saying, okay, Manish. Then Rohan is saying if no specific Ind AS, then draft accounting policy as per conceptual framework. You are partially right, Rohan. Manoj is saying Ind AS. Okay, so Ind AS 1. So Manoj, again, Ind AS 1 is not dealing with any accounting. Ind AS 1 only talks about presentation of financial statement. Okay. Friends, if no specific Ind AS is available, very important. A time question will come, right? By just diluting you. Okay. If no specific Ind AS is available, judgment should be applied to develop a policy which result in relevant and reliable information. If no specific Ind AS is available, you have to apply a judgment. Judgment, which judgment? High court judgment, Supreme Court judgment, which judgment? कौन सा judgment? Which judgment has to be applied? High court judgment or Supreme Court judgment? Dimag. Dimag has to be applied. Brain has to be applied. Wisdom has to be applied, right? Not High Court, Supreme Court judgment. A judgment has to be applied. A wisdom has to be applied to develop a policy which resulting into the relevant and reliable information. Okay, right? A judgment has to be applied which resulting into the relevant and reliable information. Okay, right friends, a judgment should be applied to develop a policy which results in relevant and reliable information. Now sir, judgment is very subjective word. We are learning Ind AS 8 for the first time and you are thinking we small kids, we should apply the judgment in development of an accounting policy. Sir, अगर कुछ और guidance मिलती तो मजा आ जाता. Okay, so standard has given a guidance while applying the judgment. So standard has told if you have to apply your dimag, if you have to apply your brain, these are the guidances which you need to refer for applying your dimag and the brain. Okay, number 1, like one of the students said, sir, if no specific Ind AS is available, we will apply the requirements which is given in the similar standard. So we will see if a specific Ind AS is not there, we will see whether any similar Ind AS is there, which is dealing with the same situation, which is dealing with the same item issues. Okay, the requirement in Ind AS dealing with the similar and related issues. If there is no standard on intangible asset, whether any standard exists which deals with the tangible asset, right, or some other kind of intangible asset, whether any standard exists, okay, or whether standard exists on these kind of non-monetary asset, for example, right? So if no specific Ind AS is available while developing the accounting policy, first you need to apply the requirement which is given in similar standard if any similar standard is there. Let me give you a real life example here. Okay, let me give you a real life example. कौन सा example? कौन सा example, my dear friends? Real life example from the listed companies annual report, right? I'm not opening the annual report, I'm just giving you that example, right? What is that example? Indus Tower Limited and Bharti Infratel Limited. Have you heard about these companies? Bharti Infratel Limited and Indus Tower Limited. These are the telecom tower companies, subsidiary of Bharti Airtel, listed company, right? I was the reporting head of that company. Okay. So Bharti Infratel Limited and Indus Tower Limited merged. Both the company got merged in 2020, in the year 2020. Now what happened? This merger was resulting into the formation of a joint arrangement. This merger was resulted into the formation of a joint arrangement. Formation of a joint arrangement. Okay. This merger was resulted into the formation of a joint arrangement. Okay. So now, if you see, there is one standard which deals with merger and acquisition. Which standard deals with the merger and acquisition in Ind AS? Which standard deals with the merger and acquisition in Ind AS? Ind AS 103, business combination standard. You are absolutely right, Saminathan. So if you see Ind AS 103, and you are also right, Manish. So Ind AS 103 deals with the merger and acquisition, deals with the business combination accounting. But surprisingly, when you go to the scope paragraph, it says that Ind AS 103 is not applicable to the formation of joint arrangement. If a merger is resulting into the formation of a joint arrangement, then Ind AS 103 does not deal with the formation of a joint arrangement. यहां तक बात समझ में आई? Whatever I have told, have you guys understood it? I'm not teaching you business combination. I'm not teaching you joint arrangement. I am just telling you some story in English. मैं आपको इंग्लिश में एक स्टोरी बता रहा हूं, आपको वो स्टोरी समझ में. रविंदर, Ind AS 111 talks about the joint arrangement reporting, means the consolidation of joint arrangement. It does not talk about the formation of joint arrangement. Ravinder, for example, when you acquire a subsidiary, which standard is applicable? Whether Ind AS 110 will be applicable or 103 will be applicable. On the acquisition date accounting, 103 is applicable. But on the reporting date, which standard is applicable, Ravinder, if there is a subsidiary? 110. Because reporting date standard is 110, consolidated financial statement. Acquisition date standard is 103. Likewise, Ravinder, 111 is Ravinder, joint arrangements reporting standard, right? But there is no acquisition date standard for joint arrangement. Is that clear? Yes. So there was no standard which was talking about formation of joint arrangement, right? So, and this question came to me and I'm teaching. This was out of the scope from 103. So now the question was, my CFO was asking me, Alok, how will you do the accounting of this entire joint arrangement? This is 10,000 crore rupees of accounting. How will you do that? So then I told, okay, not to worry. If 103 does not covers this accounting and there is no other accounting standard which deals with the formation of a joint arrangement accounting, we will go to Ind AS 8. We will go to Ind AS 8. And through Ind AS 8, we went to Ind AS 8 and we told Ind AS 8 that, dear Ind AS 8, we have to draft an accounting policy. We have to draft a policy of accounting of this joint arrangement, but we don't have any specific Ind AS. So Ind AS 8 told, okay, you don't have any specific Ind AS. Do you have any similar Ind AS which deals with the merger and acquisition? Not as a joint arrangement merger, but is there any standard which deals with merger? I said, yes. There is Ind AS 103. Now, Ind AS 8 told me, okay, go to Ind AS 103 again and tell my name. Tell that Ind AS 8 ने भेजा है. Tell that Ind AS 8 has told me to come to you. Then I went to Ind AS 103 and I told, dear Ind AS 103, Ind AS 8 has sent me here. Then Ind AS 103 said, okay, please come. Okay. So friends, so we did Ind AS 103 accounting, but not directly through Ind AS 103, through Ind AS 8. Why? Not through the specific Ind AS, through the similar Ind AS, right? So we applied Ind AS 103 and we did the similar Ind AS accounting. Is that clear to everyone or is that clear to everyone? Is that clear to everyone or is that clear to everyone? I need confirmation from all the 8-9 students who are listening me live. So Saminathan has confirmed, Manoj has confirmed, Manish, Rohan, Ravinder, Almas, Banu. Yes, still I am missing one candidate. Aruna, Sai Kiran has also clear. Aruna, are you clear on this? Aruna, are you clear on this? Okay. Yes, everyone is clear. Great, great. Have you found this example? Amazing example. Yeah. So this is a real life example. You can see the annual report of annual report of Indus Towers Limited for the financial year 2021. For the financial year 2020-21. Okay. Yes. Clear? Okay. Great. Thanks, Manish. Thanks, Saminathan. Yes. Now, sir, if so, while developing an accounting policy, sir, even if the similar index is not available, then what should I do? So one of the student was saying, sir, please apply the conceptual framework. Sir, you have taught us conceptual framework, and conceptual framework is mother of all Ind-AS, right? Conceptual framework is mother of all Ind-AS, right? So Ind-AS have been developed and drafted using the conceptual framework. Sir, please refer the conceptual framework. Okay. Sir, what happens if we will not get the answer with the help of the conceptual framework also? Then Ind AS 8 says that you have to refer. You have to refer the most recent pronouncement given by International Accounting Standard Board. Friends, why? Why the Ind AS 8 is referring to IASB? Why Ind AS 8 is saying that you have to refer the most recent pronouncement by International Accounting Standard Board? Why? Friends, because International Accounting Standard is mother body of IFRS. International Accounting Standard Board, International Accounting Standard Board, right? International Accounting Standard Board has international IASB is developing the IFRS, International Financial Reporting Standard. They used to issue a lot of guidance around IFRS. Okay. So friends, our Ind AS are the converged version of IFRS applicable to India. So our Ind AS have come from IFRS. So since our Ind AS come from IFRS, so that is why, and IFRS are such an advanced standard that IASB is continuously engaged in developing these IFRS standard. IASB is continuously engaged in developing the IFRS standard. Okay. So friends, that is why we have to refer the guidance. If there is any guidance which is given by IFRS, we have to refer that guidance. Okay. Then, sir, if no guidance is given in IFRS also, then you have to refer the guidance given by other standard setting bodies, right? Other standard setting bodies means like US GAAP. Okay. So if no answer is given by US GAAP, other accounting literature of, or even if no answer is given by other accounting literature, accepted industry practice. So in these kind of accounting, in these kind of situations, what others industry are doing, right? Is that clear? So now let's discuss a question. Okay, friends, in accounting policy, we discussed to define what is accounting policy, how to select and apply an accounting policy. These three items we will be discussing. And in case of change in accounting policy, it has to be retrospective calculation and retrospective application, right? We have already covered in Ind AS 1. We'll cover it today also. Let's discuss a question. Question number 1. Rohan has joined a company after qualifying his CA exam. Okay. His company has entered into a unique transaction, right? Transaction where specific accounting guidance is not available, right? Where specific guidance, accounting guidance is not available. This transaction is a material transaction, and important for the users to understand the transaction for taking decisions, right? For taking decision. Okay. Suggest how this accounting policy can be drafted. How this accounting policy can be drafted, right? How the accounting policy can be drafted. How the accounting policy can be drafted for this transaction. How this accounting policy has to be drafted for this transaction if no specific index is available? Solution. The accounting policy needs to be drafted using the below guidance in descending order, right? Number 1, A. What is A? Similar index. B, conceptual framework. C, what is C? C, IFRS guidance, means IASB guidance. IFRS guidance issued by IASB. Then D, other standard setters guidance like US GAAP. Then E, industry practices. So industry practices or other accepted accounting practices or other accepted accounting practices, industry practices, right? So this is how the guidance needs to be followed for developing an accounting policy, right? For developing an accounting policy. Now, question number 1. Again, I am repeating. Question number 2. So Rohan has joined a company after qualifying his CA exam. His company has entered a unique transaction where specific accounting guidance is not available. This transaction is a material transaction important for the users to understand the transaction for taking a decision, right? So, guidance on this is available only in one of the interpretation in the IFRS literature. In one of the interpretation in the IFRS literature. Suggest how the accounting policy can be drafted for this transaction. Tell me how the accounting policy can be drafted for this transaction. Suggest how the accounting policy can be drafted for this transaction under Ind AS. बताइए कैसे होगा under Ind AS? Very simple. Tell me quickly how this accounting policy can be drafted. So again you will do the same step. You will see whether similar index is there. No. Conceptual framework is there. No. IFRS guidance, interpretation under IFRS guidance is given, right? So we need to follow interpretation under IFRS guidance for developing the accounting policy. Right? We need to refer IFRS guidance for developing the accounting policy. Okay. For developing the accounting policy. Okay. If any specific index deals with it, then apply guidance from it, and not available, then refer IFRS guidance or interpretation. Rohan, you are absolutely right. Yes. Is that clear? Very much clear? Okay, great. Let's move on. Material accounting policy information. Friends, if there is a material accounting policy, you have to give the accounting policy, right? So if there is immaterial account, what is the concept of material accounting policy? Let me summarize and let me just let me touch upon quickly. Material accounting policy, if any item which is material for the understanding of the user of the financial statement. For example, a company's balance sheet size, or a company is $1 billion company, the balance sheet size is 20,000 crores. The company has purchased some assets, right? And the PP block of the company is 5 crore. So friends, the balance sheet size is 20,000 crores, and the company has a PPA for 5, company has a property, plant and equipment for 5 crore. Whether it will be considered as a material? Whether it will be considered as material? भाई 20,000 करोड़ की बैलेंस शीट में 5 करोड़ का पीपी है, क्या वो मटेरियल होगा? हाँ या ना? यू ऑल आर चार्टर्ड अकाउंटेंट. No, it is not material. Absolutely right, Manoj and Rohan. It is not material. So, friends, you know what? Whether you are required to give the accounting policy of PPNE, are you mandatory? Are you mandatorily required to provide the accounting policy of PPNE? If it is not material, are you obligated to provide the accounting policy of PPNE? What is your view? What is your view? Are you obligated to provide the accounting policy of PPNE? Yes or no? Yeah. No, you are not required to provide. You are not required to provide the accounting policy of PPNE. No, you are not required to provide the accounting policy of PPNE. Right? Why? It is not material. So, friends, let me tell you why this materiality concept has come for accounting policy. Earlier, it was not there. Yes, Saminathan, you are absolutely right. It is not mandatory, but voluntary. We can give the accounting policy of non-material, even the immaterial item. But if the item is material, if the item is material, then if the item is material, then you have to give the accounting policy of that item. It is mandatorily required. If you're not giving, if you're not giving the accounting policy of the material item, it is non-compliance of Ind AS 1 and Ind AS 8. Okay. Now, friends, tell me why this concept of material accounting policy information has come. You all have seen the financial statement of a corporate entity or a non-corporate entity, for example. Have you seen the financial statement? Have you audited the financial statement, all of you? Can I have the confirmation from all 8 students who are live in this class? Yes? Quickly. The more you engage, the more you interact, the more you learn. The more you learn. Yes? Yes, absolutely yes. Okay. Now, friends. So what happened? The company used to provide accounting policy in 10-12 pages, right? Accounting policy section is one of the biggest section in the notes to accounts. You all agree with me? So, you know, when you look at the accounting policy of any company, what they do, they write the Angrezi, they write the English in the accounting policy section for every item. Whether it is there, it is not there, they write the accounting policy, for every item. They write the accounting policy for every item, whether it is there, whether it is not there. They write the accounting policy for every item. Okay. Now, friends, you are a user of the financial statement, and let me ask you, in your financial reporting paper, only Ind AS is getting asked. If in your financial reporting paper, accounting standard is also included, US GAAP is also included, other standards are also included, right? Will you be able to become an expert in Ind AS by reading the financial reporting paper? Will you be able to become an expert in Ind AS? When you qualify your Ind AS exam, can I tell you that you are an expert in Ind AS if multiple standards were there? When I say multiple standard, multiple GAAP are there in your financial reporting paper? Yes, Manoj? No? Right? So basically, what I am trying to say, if you guys would have been loaded with a huge round of, material. India's material is also vast. But what you are learning Indian accounting standard. But if institute will overload you with all other gaps also, US gap, IFRS, in accounting standard, UK gap, if institute will overload with all these kind of gaps, you will not have a specialization and you will lose the focus. You will lose the focus. Yes, you're absolutely right, Rohan. Our focus will get diluted. Likewise, if you put everything in your accounting policy, your balance sheet has 20 items, right? Borrowing cost. I have seen in the accounting policy of many company, they don't have the borrowing, but they have the borrowing cost accounting policy. Have you guys seen it? Borrowing नहीं है, पर borrowing cost की accounting policy है. So I have seen many companies that don't have investment, but they have the accounting policy on investment, right? They don't have the financial asset at fair value through OCI. They have accounting policy on financial asset at fair value through OCI, right? So the point is what I'm trying to say here. I'm trying to say here. So Saminathan is saying they are futuristic. If they are futuristic, they just need to consider it outside the financial statement and incorporate when the transaction will arise in future, when future become current, okay, or past. So the point I'm making here, people are making the financial statement accounting policy in the financial statement notes to accounts very bulky, and they are giving everything in that. So when the user is reading that, user will lose the focus. User will get digress and diluted, right? So I am reading accounting policy of borrowing cost. Borrowing is not there. I'm just confused. This company does not have borrowing, but they said that the borrowing which is related to acquisition, construction, or production of a qualifying asset will be capitalized. I can't see the borrowing cost in P&L balance sheet, but policy is there. They don't have the investment, but they have given the policy of investment, right? The largest item is, for example, property, plant, and equipment. The property, plant, and equipment accounting policy is sitting at 10th item, and all these accounting policy items, which are immaterial, those items are there which are immaterial. Okay, so that is why a concept of materiality has come, and it says that if an item is material, you have to give the accounting policy information for that item. While giving the accounting policy information, you don't just need to copy paste the standard. You have to give the specific information relating to the entity, how that entity is dealing with that item. Okay. So this is what guidance talks about the material accounting policy information. Okay. Now, you remember we have spoken about three aspects in change in accounting policy. Number one, when to apply a change in accounting policy, when to change. Standard, you tell me when to change in accounting policy. आपका अपना सिलेबस आप अपना सिलेबस नया वाला पढ़ना कब शुरू करोगे? जब इंस्टीट्यूट चेंज करेगा. Till 2016-17, till 16-17, the CA final students were not reading Ind AS in detail. But after 2017, they started learning this Ind AS in detail. Why? Because institute had changed the standards, institute had changed the syllabus. So an entity shall select and apply. First of all, the entity shall select and apply the accounting policy consistently from one period to another, consistently, right? From one period to another, until and unless a change is required by an Ind AS. Until and unless a change is required by an Ind AS. Classic example. In 2019, effective from 1st April 2019, can anyone tell me what was the big change happened in effective from 1st April 2019? There was a big change in the era of Indian accounting standard, lease accounting. Manish and Samanathan has told Ind AS 116, lease accounting, right? Ind AS 116 lease accounting. Okay, he has told Ind AS 116 lease accounting, right? Lease accounting. Now, my dear friends, when this Ind AS 116 came, prior to Ind AS 116, there was accounting standard 9, there was Ind AS 17, and Ind AS 17, Ravinder, AS 19 was in accounting standard, Ind AS 17 was there in Ind AS. Okay, so so the accounting of lease, the lessee accounting has drastically changed when Ind AS 116 came effective from 1st April 2019. And my dear friends, every company has changed this accounting. Every company has changed this accounting. Right? Why? Because the old standard was deleted and new standard has issued. So if there is a requirement, there is a requirement of an Ind AS. There was a requirement of Ind AS, and hence it has done, and hence it has happened. Right? So you have to change the accounting policy if there is an amendment in Ind AS or if there is a change in Ind AS. Okay? Or the change in policy is resulting in the financial statement providing more reliable and more relevant information. The change in accounting policy results in providing more reliable and more relevant information on the financial position, performance, or cash flow of the entity. For example, an entity has applied a revaluation model for property, plant, and equipment. For example, the cost of PP was 1 CR, 1 crore. The company has opted for a revaluation model in the last year and it was 1.2 CR. The company has revalued it on the 1.2 CR. When this year company came, for example, on 31st March 26, there is lot of volatility due to the economic crisis or due to the turbulence in the economy. There is lot of volatility in the real estate prices. The prices are going up, coming down, going up, coming down, going up, coming down. Every day the prices are fluctuating like anything. Like gold. You have seen a lot of fluctuation in gold and silver in the last 3-4 months. Have you guys seen it or not? Have you guys seen it, the fluctuation in the gold or silver or not? Tell me. Yeah, you have seen. So there was a lot of fluctuation in the real estate prices in this year. For example, from 1.2 crore on 25th March, the price has gone down to 80 lakh. On 31st March, the price has gone up to 1.3 crore. On 5th April, the price has gone down to 95 lakhs, right? Okay. So lot of fluctuation is there, friends. When lot of fluctuations is there, so right from the balance sheet date, I mean to say 31st March to preparation of the financial statement to approval of the financial statement, the price is volatile like anything. The price is volatile like anything, right? Okay, the price is volatile like anything. So friends, now the question is, whether in this case revaluation model is appropriate or cost model is appropriate. In this case, whether revaluation model is appropriate or cost model is appropriate. Yeah. In this kind of situation, cost model is appropriate because lot of fluctuation is there. So in this case, if you show it at 1.3 crore, it will not reflect a right picture because the price has gone down to 95 lakhs, right? So in this situation, the cost model will reflect more relevant and more reliable information, right? And hence, instead of revaluation model, cost model has to be applied in this case, right? So when you can change the accounting policy, when to change? You have to change the accounting policy in two scenarios. Number one, when it is required by an Ind AS. Number two, when it is reflecting the financial statement providing more reliable and more relevant information. Okay. So Sai Kiran is asking, sir, please explain the Vedanta demerger through the annual report, cover the annual report. Sai Kiran, if I have to cover this annual report and this topic is not related to my topic, so if I'll cover it, so probably those who have purchased the share of Vedanta, it can be relevant to them. But for you guys, I will not be able to complete my today's topic, right? Because it is not related to Ind AS 8 or Ind AS 1. If I have to explain this Vedanta demerger and the annual report, it will take around half an hour, okay? And it is not related to this standard. So in this standard, we have to understand accounting policy, accounting estimate, correction of errors, the type of question which may come into the exam, okay? So we are going to cover that. Concepts we are going to cover, right? Okay. Now, when a change will not be considered as a change in accounting policy, when there is a change, but it will not be considered as a change in accounting policy. When, friends, there are some exceptions which is given in the standard. There are some exceptions which is given in the standard. If a change is due to different economic condition or new event or condition, if a change is due to different economic condition or new events or conditions, if a change is due to different economic condition or new events or conditions, right? For example, a company has purchased a building and the company is using this building for their own business purposes, right? For their own business purposes. Okay, so let me write down a question for you guys also, so that you will have a handy material. Question number 3. A company is applying Ind AS 17 for the lease accounting, and charging the lease rental to P&L account, right? This is what you have read in your old accounting standard or Ind AS. So new Ind AS 116 requires the entities to capitalize the lease rentals and recognize the ROU asset and lease liability. Suggest if the entity should change the policy. Solution: yes, in line with the requirement in Ind AS 8, the company has to change the accounting policy for leases, since new Ind AS 116 has replaced the old Ind AS 17. Okay, the old Ind AS 17. Is that clear? Okay, now question number 4. A company has purchased a building and using that building for the business purposes, right? In FY 24-25. Now the company has applied Ind AS 16 for the accounting of this building, considering it as a PPE, property, plant and equipment, right? PP. Due to a cash crunch, company shifted its office in a smaller rental premises and leased out its own building in FY 25-26. So now the company has changed the accounting policy policy of Ind AS 16 PPE to Ind AS 40 investment property. If you have not covered this standard, not to worry, I'll cover this standard later on. Okay. Ind AS 16 is on property, plant and equipment. Ind AS 40 is on investment property. Okay. Right. So now the company has changed the accounting policy of Ind AS 16 PP to Ind AS 40 investment property. Whether this change will be considered as a change in accounting policy, in line with Ind AS 8. What is your thought? Whether it will be considered as a change in accounting policy in line with Ind AS 8? आपका क्या व्यू है, होना चाहिए? Rohan is saying it is not a change in accounting policy. A change is due to condition of use. You are absolutely right, Rohan. Yes, if the change is due to different economic condition, new event or condition, it will not be considered as a change in accounting policy. If change is due to a different economic condition or new event or condition, it will not be considered as a change in accounting policy. So here, the company was applying Ind AS 16 because it was for the own business purposes. So it qualifies the definition of property, plant and equipment. But when the company has taken it on a rental basis, when the company has given it on a rental basis, so it becomes an investment property. The definition of investment property is, Saminathan, land and building held for capital appreciation or held for rental purposes. So event or condition has been changed. So this PPE now qualifies as an investment property and hence it has to be changed. So friends, whether we will give the third balance sheet, give the retrospective application, or we have to do the prospective application. We have to do the prospective application, not the retrospective application. We have to do the prospective application, my dear friends. Okay. We have to give the prospective application, right, in the current year only. We are not required to change the comparative. We are not required to give the opening of the comparative balance sheet. Now, second exception is previously immaterial effects. There was a $1 billion company whose balance sheet size is 25,000 crore. The revenue is 3,000 crore. Profit is 600 crores. This company has purchased a tally software and the company has charged this tally software into the P&L. Whether this tally software is an intangible asset? Sir, but we need to update the accounting policy. No more PP. Yes, you are absolutely right, Saminathan. You have to update it. But the only thing is, my dear friends, the only thing is whether we have to give the retrospective application. We have to give the retrospective application, right? We have to give the retrospective application. Yeah. Yes, we have to give the retrospective application. No, we are not required to give the retrospective application. No, right? So my dear friends, if I talk about this thing, so intangible asset, tally software is an intangible asset. Okay. So whether I need to, this tally software is an intangible asset. So if this company has charged off this tally software in the P&L, so whether it is a wrong accounting treatment, answer is yes, it is a wrong accounting treatment. But can the company do so? Yes, on the materiality ground. Since 1 lakh rupees immaterial, this company is rounding of this number in millions, crores. So 1 lakh rupees immaterial to them, and hence on the ground of materiality, they have charge off into the P&L. But in the second year, they have changed this tally software. They have changed this tally software to the SAP or ERP. Change this tally software to SAP or ERP. Okay. Tally software to SAP or ERP. So now in this case, my dear friends, if they have changed this tally software to SAP or ERP, they implemented SAP or ERP and they spent 5 crore rupees in implementation. So now can they charge off this 5 crore rupees of SAP or ERP implementation into the P&L? बताइए, 1 लाख रुपए पिछली बार जो इंटेंजिबल एसेट था उसको पीएनएल में चार्ज कर दिया, तो 5 करोड़ भी पीएनएल में चार्ज कर दें? आंसर इज नो. सो लास्ट टाइम you have charged your intangible asset into the P&L. Now this time you have capitalized your intangible asset into the balance sheet, right? So friends, in this case, will it be treated as a change in accounting policy? In this case, will it be treated as a change in accounting policy? Will it be treated as a change in accounting policy? Tell me. Accounting policy treat होगा क्या? Change in accounting policy treat होगा? Yeah. Will it be treated as a change in accounting policy? No, it will not be treated as a change in accounting policy. Why? Because earlier we did a different accounting treatment because of the immaterial effect, right? If had this been material last time also, then of course it was in the last time itself it was an error. Okay, right? You are absolutely right. So in these two circumstances, it will not be considered as a change in accounting policy. Now, if there is a change in the accounting policy and it has been considered as a change, so number two, there are two aspects to it. Number one, the change can be due to a new accounting standard, new Ind AS. Second, the change can be due to voluntary change. Means standard has given you two options. Standard has given you two options. Earlier you were opted for one option, now you switched off to the another option. So sir, what happened? If we are changing our accounting policy, like we shifted from Ind AS 17 to Ind AS 116 for the lease accounting, sir, we have applied the new Ind AS, right, for changing our accounting policy. How will we take this change? So first of all, if you are changing your accounting policy due to new Ind AS, then you have to see whether any transition related provision is given in the new Ind AS. Whether any transition related provision is given in the new Ind AS. If yes, if the transition related provision is given in the new Ind AS, you have to apply those transition provision as per the new Ind AS. For example, when Ind AS 116 came, right, Ind AS 116 has given the transition related provision. You know what was that? So while whenever there is a change in accounting policy, it has to be applied retrospectively. Means you have to change the comparative, you have to give the third balance sheet, and you have to change right from. But 116 has given an option for the first time for the transition related option. And you know what 116 told? 116 said that if you want to do a prospective application of Ind AS 116, you can do that. And many companies has opted for that prospective application which is given in the transition related provision. Why? It is very simple. You are not required to go into the past and restate the numbers and give the third balance sheet and do the computation from the past. You just need to do the changes from the current year. So friends, if the change is due to new Ind AS, if change is due to new Ind AS, then you have to apply the transition related provision given in the new Ind AS, right? And the transition related provision, it gives you both the option. It gives you, it normally gives you retrospective option also and the prospective option also, right? It gives you both the option. Okay, right friends? Let's move on. Let's move further. Sir, if no transition related provision is given, then you have to apply retrospectively. Then you don't have any choice. Sir, if we are applying the change voluntarily, then it has to be applied retrospectively. Then it has to be applied retrospectively. Friends, let me quickly show you what is the presentation and the disclosure requirement when there is a change in accounting policy with the help of the ONGC annual report. And this annual report I have shown you in Ind AS 1 also, because I have covered this concept in Ind AS 1 also, which is the concept of the third balance sheet. Quickly I am covering here as well. Okay. Quickly I am covering here as well. Quickly. I'll not spend much time. I'll quickly show you. Friends, I hope you are able to see the balance sheet. I hope you are able to see this balance sheet. Yes. Of ONGC annual report. If you see this balance sheet, standalone balance sheet as on 31st March 20. So 31st March 20 balance, 31st March 19 comparative, and opening of the comparative 1st April 18. And in both the dates, in both this balance sheet, they are given some star mark, and you can see the third balance sheet they have also given, right? Third balance sheet they have also given. So now what is the meaning of the star mark? Restated, refer note number 54. Then they have given the comparative P&L. There is no third P&L because balance sheet is as it, but P&L is for the period ended, for the year ended. So they have given the current year P&L and the last year P&L, and in the P&L they have also given the star mark. What is meant by star mark? Refer note number 54. Then they have given the statement of changes in equity, and they have given the statement of cash flow for current year, comparative year. In the comparative year they have given the star mark, and the star mark means restated, refer note number 54. Can we go to the note number 54 again? Why I'm saying again? Because in Ind AS 1 we have also captured it. Okay. You can see disclosures as per Ind AS 8 and Ind AS 1. As I told you, I have covered this part in Ind AS 1 also. So this disclosure is as per Ind AS 8 and Ind AS 1. Okay. In accordance with Ind AS 8, accounting policy changes in accounting estimate and correction of error, and Ind AS 1 presentation of financial statement, the company has retrospectively restated its balance sheet as on 31st March 2019 and 1st April 18 opening of the comparative period, and a statement of P&L for the year ended 31st March 19 for the reason mentioned below. And I'm not getting into the reason. You know what they did? They have changed the accounting policy of government grant. They have changed the accounting policy of government grant, right? They have changed the accounting policy of government grant. Friends, this is the, so basically when you read the accounting standard for government grant, accounting standard gives you two choices, right? I'm talking about government grant standard. I'm not explaining the government grant standard. The first choice is measuring government grant and the asset at fair value. The second, measuring government grant and assets at nominal value. Measuring government grant and assets at nominal value, right? At nominal value. So friends, this ONGC Limited has changed the accounting policy voluntarily, and that is why they have given the retrospective application. Okay, they have restated the comparative number, given the third balance sheet, and they have also shown the disclose the reconciliation of last year balance sheet and opening of the last year balance sheet, previously reported number, adjustment, restated number, right? And they have explained all the adjustment in the notes. Okay, likewise in the P&L they have also explained what was the last year already reported P&L, what is adjustment, what is restated number. They have explained this adjustment. They have also given the earnings per share, basic and diluted earning per share change, right? They have also given reconciliation of statement of cash flows, previously reported adjustment or restated number, right? And this is what they have given as a note number. Okay, right? And they have explained all the notes. So friends, these kind of disclosures are required in case of change in accounting policy. You have to give all the changes in account, disclose nature of the change, like they have explained. No, they have changed the accounting policy for government grant, amount of adjustment for all financial statement item, earning per share into prior period. So they have given the balance sheet reconciliation for two period, comparative and opening of the comparative, and P&L reconciliation, earning per share, okay, for the current period and for the comparative period and the prior period. If judged impracticable to apply retrospective, explain why and how applied. If you know that you have to take the impact of this change in accounting policy, you have to take the impact of change in accounting policy for last 11 years, but you don't have the accounting records, for the last 11 years. Why? Because 6 years back there was a fire in the premises of the company, and all the accounting records were destroyed 6 years back, and all the accounting records were destroyed 6 years back. Okay, now friends, if all the accounting records were destroyed, in this case Tell me how this company will take the impact from the last 11 years. Can the company take the impact from the last 11 years? No. So from which date the company will take the impact of the change in policy? From the last 6 years only? Yes. So standard says that from wherever it is practicable to apply from the last 6 years, you can take the impact and apply the change of the accounting policy. So please do that. From wherever it is practicable to apply, please apply from there, but explain why you have not taken the impact of change in accounting policy right from the beginning, last 11 years, right? If not, then how you have applied? So all these disclosures are required to be given. Is this clear or not clear? भाई आपको शुरू से अप्लाई करना है चेंज इन अकाउंटिंग पॉलिसी, लेकिन अगर नहीं कर पाए, if you are not able to change the accounting policy right from the beginning, then from where you have applied you need to disclose, right? Okay. So Sai Kiran, for example, this change in policy has a result from last 50 years. Example, Sai Kiran, like Tata Steel Limited. Tata Steel was incorporated in 1907, but in the balance sheet numbers are brought down and carry forward, right, Sai Kiran? Okay. So think about, Sai Kiran, if standard setter has captured this kind of provision in the standard. Why they have captured this kind of provision? Tata Steel has purchased a land in 1910. This land is coming in the balance sheet of Tata Steel after 116 years, on 31st March 26 also. Now, Sai Kiran, if the company changing the accounting policy of this land, this requires a change right from 1910. But is it possible to go back in time 116 years back? Saying whether MCA do have the records for last 116 years? No, MCA does not have the record, right? So that is why if you are applying a accounting policy change retrospectively, the basic principle is it has to be applied retrospectively from the beginning. But if it is not practicable to apply right from the beginning, you can apply from the date wherever it is practicable to apply. You can apply from the date wherever it is practicable to apply. Wherever it is practicable to apply, my dear friends, right? My dear friends, okay? Yes. If on application of a new Ind AS, also report. If you are applying a new Ind AS and you are changing the accounting policy, you have to do all these facts. But if it is a new Ind AS, you have to report what is the title of new Ind AS. For example, you have to write Ind AS 116 leases. What is the transition provision which are applied and what is the likely future effect of this new Ind AS? Okay. Is that clear? Let's go to the next part, change in accounting estimates. Very simple. What are the example of estimates? What are the example of estimates, guys? What are the example of estimates? What are the example of estimates? Many example of estimate. पहला एग्जाम्पल तो आपने बचपन से देखा, यूजफुल लाइफ ऑफ द फिक्स एसेट, इंटेंजिबल एसेट, इन्वेस्टमेंट प्रॉपर्टी, रेसिडुअल वैल्यू, स्क्रैप वैल्यू, राइट? यूजफुल लाइफ, depreciation method, whether depreciation method is a change in estimate or change in policy. Yes, impairment, fair value, actuarial valuation. Manoj, depreciation method is a change in estimate. Depreciation method is a change in estimate. When you read Ind AS 16 property, plant and equipment, you will find this depreciation method depends on the expected consumption pattern of the asset. It depends on the expected pattern consumption of the asset, estimated pattern of the consumption of the asset, right? So depreciation method is a change in accounting estimate, even in accounting standard, not only in Ind AS, even in accounting standard and IFRS also, right? Saminathan, yes? You are aware that depreciation method is a change in estimate, not a policy change? Yes. Okay. Rohan? Yes. So change in depreciation method is a change in estimate. So a lot of example of change in estimate: provision for doubtful debt, residual value, right? Your residual value, useful life, warranty obligation. So lot of examples are there. Okay. Lot of examples are there. So friends, what is an accounting estimate? As we all understood, it's an estimate, not 100% accurate, but best estimate. So accounting estimates are monetary amounts. Accounting estimates are monetary amounts. Okay. Accounting estimates are monetary amounts in financial statement that are subject to measurement uncertainty. These are the monetary amounts in the financial statement which are subject to the measurement uncertainty. Which are subject to the measurement uncertainty. Right? So like you are measuring your depreciation. What is depreciation? Depreciation is an accounting estimate which is subject to the measurement uncertainty. When I'm saying it is subject to the measurement uncertainty, when I'm saying it is subject to the measurement uncertainty, what does it mean? When it is subject to the measurement uncertainty, it means if tomorrow the useful life will change, the depreciation will also change, right? It is not an accurate amount. It is a best estimate. It is a best estimate. Okay. It is a best estimate. So accounting estimate is a monetary amount which is subject to the measurement uncertainty. Example, bad debt, useful life, residual value of fixed asset, right? Warranty obligation, inventory obsolescence, fair value of financial asset or liability. Okay. Friends, if it is not clear whether it is a change in policy or change in estimate, what do you consider it? If it is not clear whether it is a change in policy or change in estimate, what will you consider it? क्या कंसिडर करोगे? आपको समझ नहीं आ रहा कि चेंज इन पॉलिसी या चेंज इन एस्टिमेट है. व्हाट यू विल कंसिडर दिस एज अ चेंज इन एस्टिमेट. You will consider this as a change in estimate. Okay. If it is not clear whether it is a change in policy or change in estimate, you have to consider it as a change in estimate. Okay. Accounting for change in accounting estimate. Sir, what is the accounting? Friends, this is very simple. Whenever change in depreciation method, useful life, residual value, recoverable amount, provision for doubtful debt, everything has to be applied prospectively. Everything has to be applied prospectively. Prospectively means you have to recognize it prospectively by included in profit or loss in the period of change if the change affects that period only, or the period of change in the future period if the change affects both. Okay, if the change affects both, right? Sir, contingent liability is also an estimate. Yes, if you are estimating the number of the contingent liabilities, and it is an estimate. And yes, because when you are talking about contingent liability, you are estimating whether it is possible obligation, present obligation. Okay, so it is likely to be an estimate. Okay. Yes. What are the disclosure which are required whenever there is a change in accounting estimate? What are the disclosure which is required? So effect of change in accounting estimate on the current period. If applicable and practicable, effect of change in estimate on the future periods. For example, the asset cost was 1 lakh rupee. The asset cost was 1 lakh rupee. Okay. The life was 10 years. What is the depreciation per annum? 10,000. 10,000 is depreciation. In the next year, what is the remaining life? So after 1 year, what is the remaining life? 9 years. What is the remaining amount? What is the remaining amount? 90,000 is the remaining amount. So instead of 9 years, the useful life was changed to 5 years. The remaining useful life is 5 years and the value is 90,000. What is the depreciation? What is the depreciation in this case? 18,000 is the depreciation in this case, right? So what is the impact of the change in estimate? What is the impact of the change in useful life from 10 to 5 year? 8,000. So from 10,000 rupees of depreciation, it was increased to 18,000. So there is an increase of 8,000 rupees. 8,000 rupee increase is there. So can I estimate? Can I estimate the impact in the next year also? Yes. In the next year, if the useful life will not change further, so again in the next year, the depreciation will be 18,000 rupees. So this change is impacting my current year and future year. If I can predict the change, impact of the change in the future year also, I have to disclose the impact of the change in future year as well. So number one, effect of the change in the current period. If practicable, then in the future period also. If not practicable to estimate, you need to just mention the fact that it is not practicable to estimate the effect on the future period. Sir, when it cannot be practicable to estimate the effect on the future period? Recoverable amount. So for the purpose of impairment testing, you have computed the recoverable amount. Okay. And what is the recoverable amount? Higher of fair value less cost to sell and value in use. So can you predict what will be my fair value in the next year end? Can you? So Saminathan, for useful life, not necessarily. For useful life, you can say that as per the current useful life, and I am predicting the useful life may not change substantially. You can see the annual report of many companies. Their useful life are not changing significantly, right? They are not changing significantly. So useful life is less of a problem, like fair value. How? So are you aware what will be your fair value in the next reporting date? If you have taken the fair value in the current reporting date, no. So it is impracticable to estimate the fair value of the next year. So in that case, you will not give the disclosure of the impact in the next year, right? Clear? Is it clear? Not clear? Friends, is it clear? Not clear? Please tell me. Clear हुआ या नहीं हुआ? Yes. Clear in mind or clear from mind? Clear in mind? Yes. Okay. So now, friends, thank you, Ravinder. Thanks for the appreciation. Means a lot. You are appreciating me on my birthday. Thank you so much. Yeah, great guys. Great guys. Now, friends, let me, thank you everyone. So friends, let me talk about the prior period errors. Let me talk about the errors. So we covered the change in accounting policy. We covered how to select and apply the accounting policy. We covered the meaning of accounting policy. We covered when to change an accounting policy. We covered when a change will not be considered as a change in accounting policy. We covered the application of a change in accounting policy. We also covered the disclosure of change in accounting policy. In detail, I have shown you the ONGC annual report. I have given you a lot of layman language examples. I have captured the examples in the Excel file also, right? In the Excel file also. Okay. So we covered these two aspects in detail. If you see, so we talked about these aspects in accounting policy, and we also seen the accounting treatment. Accounting treatment is retrospective calculation and retrospective application, right? This is the accounting treatment. Okay. Now, so let me write down the accounting treatment again. Accounting treatment of change in accounting policy, right? Accounting treatment is change in accounting policy. If due to new Ind AS, right? If due to new Ind AS, okay, let me write the solution of this question also. So this is due to new facts and condition. I am talking about Ind AS 16 to Ind AS 40. I have already covered it. Hence, it will not be considered as a change in accounting policy, right? I'm just completing this so that when I'll share this file with all of you, you will have the question and answer both. Okay. Now, accounting treatment of change in accounting policy. If due to new Ind AS, see the transition provision, okay, and apply accordingly. If transition provision is silent, okay, or if transition provision is silent, or change is voluntary, okay, then what you need to do? Then do the retrospective calculation, means retrospective change, and retrospective application, मतलब आपको डे वन से जब से वो ट्रांजेक्शन आई है, डे वन से यू हैव टू टेक द इम्पैक्ट ऑफ द चेंज, डे वन से, राइट? डे वन से यू हैव टू चेक द You have to take the impact of the change. Okay. Day one say. Okay. Yes. Thank you so much. Thank you, my dear students, for your lovely wishes. It means a lot. Thank you so much. Right. And it's my pleasure that I am taking a class on my birthday, right, with all of you. I started my morning with all of you. It's a real pleasure it's a real pleasure to me, right? Okay, because teaching is a love. Okay, and when you are discussing and talking with the kind of, I would say, uh, you are talking to a chartered accountants who are, with the future chartered accountants. It's absolutely an amazing feeling, an amazing experience to share. Okay. So my dear friends, yes. Now let's coming back to the topic. So we talked about the accounting treatment of change in accounting policy also, and disclosure requirement. What is the disclosure requirement? Nature of change, nature of change, FS item reconciliation, okay, and explanation of impact, right, of impact of the change. These are the kind of, you know, uh, disclosure requirement, disclosure. Okay. Then we covered accounting estimate. We covered, friends, accounting estimate. We covered, okay. So what is accounting estimate? Define what is accounting statement estimate: monetary amount subject to measurement uncertainty. And this accounting estimate has to be applied prospectively, right? Prospectively. What are the example of accounting estimate? What are the example of accounting estimate? The example of accounting estimate is useful life. Useful life. Then residual value. Residual value. Then useful life, residual value, recoverable amount. Okay. Fair value. Okay. NRV, net realizable value of inventory. It is again estimated value. Okay. These are the example. Let me write etc. also. Okay. Right. Okay, friends. So we talked about this aspect also. So now we are moving and explaining the errors, right? Let's discuss and explain the error. And before explanation of error, it's 8:34 now. Let's have a break and we will start at 8:45. Sounds good? Yes, we'll start at 8:45. Okay. Let's have a break. Thank you. Friends, let's talk about errors. When I talk about errors, whether the standard will tell you how to make an error, how to correct an error. Whether the standard will tell you how to make an error or how to correct an error. This standard tells you how to correct an error, right? Not how to make an error. Okay. So friends, the standard gives you that how to correct an error. Right? Now the question is, sir, for example, if the standard tells us how to correct an error, whether this error includes only mistake or this error also include fraud. Whether this error include mistake or this error also include fraud. Whether this error includes mistake or this error includes fraud. Yes, Ravinder, you are absolutely right. Error not only include mistake, it also include fraud, right? So your error includes mistake as well as fraud. Okay. Mistake means an unintentional error. An unintentional error is a mistake. If error is intentional, then it is considered as a fraud. If error is intentional, it is considered as a fraud. Okay. Now students, you might be thinking, sir, how can this fraud can be an error? So student, don't think like a regulator. Think like a chartered accountant. What is your role? Your role is to audit the financial statement, and your role is to prepare the financial statement if you join the management, join the company. Okay. Now friends, if your role is to prepare the financial statement or audit the financial statement, so it doesn't matter if it is an intentional error or unintentional error. What is your role? What you will do? You will correct the financial statement. Yes or no? क्या करेंगे? अगर अगर कोई गलती है, चाहे वो जानबूझ के की गई है, चाहे गलती से की गई है, what is the first step you will do? To correct the financial statement. Yes or no? If somebody has misappropriated the cash, it is a fraud. If somebody has by mistake, somebody has to record the entry of 5,50,000, he has made the entry of 5,15,000. Okay, 5,15,000 for example. So friends, in this case, it is a mistake. In the earlier case, it was a fraud. But what is the bottom line? The bottom line is you have to pass a right entry, correct entry. So it doesn't matter if it is a unintentional error or intentional error. Doesn't matter it is mistake or fraud. So we have to correct our financial statement applying the principle of Ind AS 8, which says that if there are prior period errors, means omission or misstatement in the entity's financial statement for one or more prior period error from a failure to use or misuse. Failure to use is a mistake, misuse is a fraud of the information which was available when the financial statement was prepared and the financial statement was approved, right? And example are mathematical mistake, mistake in application of accounting policy, oversight, misinterpretation, fraud. These are the examples of mistake, errors. Okay, these are the example of errors. Now friends, we already covered it, in Ind AS 1. Whenever there is a prior period error, how this prior period error has to be corrected. In accounting standard, life was very simple. You just need to take a retrospective calculation of the prior period error impact and take the number and take the impact. Take the impact just in one line item as a prior period item in the current year P&L. No need to restate comparative. No need to give the third balance sheet. No need to give any reconciliation, right? But what about Ind AS? What about Ind AS? If there is a material error, I mean to say there is a correction of material error, what is the accounting treatment in Ind AS? It is just a cut, copy, paste treatment of accounting policy change. What? Comparative needs to be restated. Okay. Third balance sheet, opening of the comparative period balance sheet needs to be given so that opening balances can be right. It can be corrected. So right from the day when this error impact needs to be taken till the opening date of the comparative period, cumulative impact needs to be taken. I have explained in detail in my Ind AS 1 lecture, right? And I have shown you the Excel file also for the third balance sheet preparation, okay? And I have taken the example of prior period errors only, right? So friends, prior period errors are corrected in the comparative information presented, okay? So you need to restate your comparative, you need to give the third balance sheet, you need to provide the reconciliation, disclosure, etc., etc., okay? But what happens if the error belongs to the last year only? If the prior period error only belongs to the last year, not prior to the last year, then will you provide the third balance sheet? Will you provide the third balance sheet then? If error only belongs to the prior period, you're not required to give the third balance sheet, right? Otherwise, it will digress the user of the financial statement. They will think, oh, this error pertains to probably 3 years back. This error pertains to the prior to the previous years, okay? This is an old error, okay? So if error belongs to the last year only, तो क्यों देनी है third balance sheet? Third balance sheet तो ठीक है ना? Is that clear or not clear? Is that clear or not clear? Right? Friends, again I am asking whether the comparative restatement, third balance sheet, reconciliation, disclosures, whether these things are clear to you or not clear to you. We have covered in Ind AS 1 also, we have covered today also, where I have shown you the ONGC annual report. The only thing is it was change in accounting policy, but I am talking about correction of error, but the treatment is cut copy paste. Okay. Yes. So if so prior period error has to be corrected right from the beginning from where this error was made. Sir, this error belongs to 15 years back, but we have the record for only last 8 years. We have the record for last 8 years only. Sir, we have the record for last 8 years only. In that case, sir, in that case, do we need to correct the error from last 15 years? Do we need to correct the error from the last 15 years? Or can I correct it from the last 8 years only? What should I do? What should I do? Yes, from wherever it is practicable to correct, I will correct from the last 8 years. Okay, from the date where the records are available. Okay, but of course you need to provide the disclosure. So what are the disclosure nature of the prior period error? Like nature of change in accounting policy. For each prior period presented means financial statement item reconciliation, right? So balance sheet reconciliation of the comparative year, third balance sheet, P&L reconciliation, earning per share, and if the retrospective restatement is impracticable for a particular prior period, for example, we have not been able to correct this error for last 15 years. We have been able to correct this error from last 8 years only. You need to disclose this fact, right? Summarizing, accounting policy means principle, basis, conventions, rules, and practices, right? And accounting policy has to be applied retrospectively until and unless it is governed by a new Ind AS. Then you need to look at transition provision. Okay. Change in accounting estimate means monetary amount that are subject to measurement uncertainty. It has to be applied prospectively. Okay. Correction of error means results from a failure to use or misuse of available information. It has to be applied retrospectively, right? Example, creation of ROU asset and lease liability at present value of lease rental over the lease term. Estimating discount rate for calculating present value. Okay. Error in calculation of right to use asset and lease liability or forgot to account for escalation in the lease period. Right. So these are the examples. Okay. Right. So we discussed this entire Ind AS 8. Talking quickly about the differences in Ind AS, it is Ind AS 8. In IGAP, it is AS 5, net profit or loss for the period, prior period item and changes in accounting policy. As I told you that AS 5 is relevant. In case of change in accounting policy, correction of error in Ind AS, it requires a retrospective calculation and retrospective application. But in accounting standard, it requires retrospective calculation but prospective application. In Ind AS, retrospective calculation, retrospective application, right? And detailed disclosure are there in Ind AS, comparatively less disclosure are there in accounting standard. Okay. So friends, we have covered Ind AS 8. Now I am moving to Ind AS 10. Okay. Now I am moving to Ind AS 10. So we covered this aspect. Errors, we discussed what is error. So whether error includes only mistake or it also includes fraud, right? We discussed. Okay. And what is the treatment of correction of error, we discussed. Now let's discuss an example. An asset is impaired if recoverable amount is lower than carrying amount. A recoverable amount is higher of fair value less cost to sell and value in use. Okay. The company has estimated the discount rate of 10%, but it was inadvertently applied at 1%. So discount rate was 10%, but due to a mistake, it was applied at 1% by the accountant while doing the value in use calculations. Identify in above what is accounting policy, what is accounting estimate and correction of error. बताइए इसमें accounting policy क्या है, accounting estimate क्या है और correction of error क्या है? Tell me. Accounting policy, accounting estimate and correction of errors. Tell me. Quickly tell me, quickly, what is accounting policy, what is accounting estimate and correction of error in this statement? First of all, this statement includes all the three items. Tell me, what is accounting policy in this statement? In this question, an asset is impaired if recoverable amount is lower than the carrying amount. An asset is impaired if recoverable amount is lower than the carrying amount. A recoverable amount is higher of fair value less cost to sell and value in use. This is an accounting policy. This is an accounting policy. Now, what is an accounting estimate? What is an accounting estimate in this question? Estimating fair value less cost to sell and value in use. Estimating fair value less cost to sell and value in use is an accounting estimate. And what is correction of error? The company has estimated the discount rate of 10%, but it was inadvertently applied at 1% by the accountant while doing the value in use calculation. This is an error. Have you understood all three in this example? Yes. Have you understood all three? Yes. Okay, great. Now friends, let me open my PPT on Ind AS 10. Let me open that. Just allow me a minute. Whether my PPT is visible on Ind AS 10? Yes. Okay. Friends, this is a very, I would say, this is very short and sweet standard. Okay, that is why these two standards has given you one class, because this change in accounting policy, correction of prior period error, the third balance sheet concept was covered in detail in Ind AS 1. And these two standards are very short and small standard. Okay. Talking about Ind AS 10, events occurring after reporting date. Events occurring after reporting date. Now the question comes, let's say you are preparing a balance sheet. You are preparing a balance sheet on 31st March 2026. Let's say I'm taking a date of 31st March 2026. Okay. When you are preparing a balance sheet on 31st March 2026, whether this balance sheet is finalized on 31st March itself, or whether this balance sheet is approved on 31st March itself, and whether this balance sheet is shared with the public on 31st March itself. Yeah. No any event was happened on 31st March. You are preparing the balance sheet of 31st March, but not on 31st March. Are you getting me? आप बैलेंस शीट बनाते तो 31st मार्च की हो, बट 31st मार्च पे नहीं बनाते. You are preparing the balance sheet of 31st March, but not on 31st March, right? So friends, that is why the balance sheet is always for the year ended. Balance sheet is as it. Financial statement for the year ended, past tense. We are talking about past tense. Okay? Or present perfect tense. So friends, let's say I have prepared the balance sheet as at 31st March 26. I have finalized getting it audited by 30th April 2026. And when my balance sheet is going to be approved, when my financial statements are going to be approved, my financial statements are going to be approved. My financial statements are going to be approved in the board meeting. You are aware or not aware? आपको पता है ना? The approval process of the financial statement for a company. 31st March is a financial year. The company prepare the financial statement, finalize it, auditor audit it, right? Then they present the financial statement along with the audit report in the board meeting. So Rohan, not AGM, board meeting. Board, right? So the board approved the financial statement, right? Then it is also placed in the AGM. Okay. But when the board meeting happen and board approve the financial statement, board adopt the financial statement, you will file the results of the listed companies. आपको पता है ना लिस्टेड कंपनी के रिजल्ट 60 डेज के अंदर फाइल करने होते हैं फ्रॉम द एंड ऑफ द फाइनेंशियल ईयर. आर यू अवेयर नॉट अवेयर? Like Reliance, Vedanta, all these companies financial results are required to be filed within 60 days from the end of the financial year to the stock exchange. Are you aware, not aware? And in those financial results, balance sheet is there, the P&L is there. When I say P&L, so it is quarter P&L, year P&L, comparative P&L, lot of columns are there, okay? And cash flow statement is also there, a statement of cash flows, and some notes which is required as per the SEBI LODR, that is also there, okay? So friends, 31st March financial statements completed by 30th of April, okay, and audited by the date, and it was approved in the board meeting dated 5th May 2026. And on 5th May 2026, like Saminathan is the shareholder of this company, listed company. So whether Saminathan got to know about the numbers, results, performance, financial position on 5th May, or he was aware before that? On 5th May, he was able to know on 5th May. Now, Saminathan, on 5th May, the information which you are getting, is it a fresh information or is it a stale information? ये बासी numbers हैं या नए number हैं? Saminathan, it's a stale information. On 5th May, you are getting a information for 31st March. You are getting a information for 31st March. You are able to know the numbers relating to the last year, number relating to the 31st March financial position. Okay. Now, let me give you an example that what is the genesis of this standard? Why this standard events occurring after balance sheet date comes? So all the Indian accounting standard, all Ind AS talks about recognition, measurement, presentation, disclosure of the financial statement. Okay. All these Ind AS talks about these things, right? All these Ind AS talks about these things. Recognition, measurement, presentation, disclosure. Okay. Now the point is these Ind AS talks about the preparation of the financial statement, means till 31st March. So what happens if any events which occurs after 31st March up to the approval of the financial statement, how those events should be treated? How those events should be treated? How those events should be treated? Okay. How those events should be treated? Right. Now, my dear friends, the question is how those events are going to be treated. Okay. Now the question is, let's say Saminathan got this information on 5th May, okay, and Saminathan has seen, oh, on 31st March 2026, the company has an inventory of 1000 crores. Saminathan is dancing, he is enjoying, he is happy. Yes, this company has an inventory of 1000 crores. But you know what happened? On 15th of April, on 15th of April, this inventory was destroyed due to a fire in the warehouse of the company, in the factory of the company. This entire inventory was destroyed. Guys, guys, this 31st March inventory was destroyed in the next 15 days. Till the time Swaminathan is reading the results on 5th of May, which is pertains to 31st of March, and Swaminathan is happy that yes, inventory is 1000 crore. Manoj, the time when he is reading the financial statement, whether the inventory is 1000 crore, whether the inventory is 1000 crore with the company, whether Swaminathan deserves to be happy with respect to the results of the company? No. Why? No. Okay. No. Why? Why? Because of two reasons. Reason number one, the inventory which is there on 31st March is no more as on time when we are reading the results, right? And I'm not talking about the normal scenario where the inventory has sold out. That is a very happy situation. I am talking about this event which happened, this unusual event which happened and which destroyed the entire inventory. Second, for taking a decision, since Swaminathan is thinking about investing more money into this company, for taking a decision, it is important to look at the results which is updated with the post balance sheet events, right? Means the events which occurs after 31st March till 5th of May, till the time the financial statement becoming public, means results becoming public. Okay. So my dear friends, this is the reason why this standard come into picture, why events occurring after balance sheet date, events are occurring after reporting date standard comes into the picture, which not deals with only the which is only dealing with the events after balance sheet date. March, sir, after 31st March till which date? After 31st March. So let's say on 31st March, the financial statement have been prepared. On 5th of May, board meeting has been happened. On 15th of June, AGM was conducted. So from 31st March to 15th June or 31st March to 5th May? What is the time period? What is the period for events occurring after balance sheet date? 31st March to 15th June or 5th May? Yes, you are absolutely right, Manish and Swaminathan. Manoj, what about you? Yes, Manoj is also saying 5th May tak. Okay, right? So it is till the date financial statements are getting approved. Okay, adopted, not till the AGM. Right? So as you can see on the PowerPoint presentation also, this is my 1st April 25. This is my 31st March 26. Okay. So all Ind AS are applicable for preparation of the financial statement. Right now, this financial statement are approved by the board of directors on 5th of June. Sorry, on 5th of May 25. So till this date to this date, Ind AS 10 will be applicable, right? Events after the reporting period. And then on 15th June, shareholder AGM has happened. So on this date to this date, Ind AS 10 was not applicable. Other Ind AS was not applicable for this financial statement. I hope it is clear to everyone, my dear friends. I hope it is clear to everyone. Now again talking about Ind AS 10, I have here also written the financial year is 25-26. April 25 is the beginning date, opening date, closing date is 31st, 26, 10th May is the board meeting date. This is my reporting date, this is my board meeting date in which the financial statements are approved. Now, events occurring after reporting period is 1st April to 10th May. Adjusting events. Now there are two types of events, adjusting events and non-adjusting events. And there are some special events also. So friends, we will be talking about three types of events, largely two types of event, adjusting event, non-adjusting event. And these special events are also adjusting or non-adjusting, right? So as a part of agenda, we will be covering adjusting event, non-adjusting event and some special events. Okay. So let me again take you to my PowerPoint presentation and discuss this thing. I hope the context is clear. Whether the context is clear or not clear, my dear friends, please tell me. Whether the context is clear? Yes. In our accounting standard, it is AS4. AS4 is the counterpart standard in AS. What is the objective and scope of Ind AS 10? This standard suggests when an entity should adjust its financial statement for events after the reporting period. Okay. So when the entity should take an adjustment for the events which is happening after the reporting period. Okay. This standard also talks about adjusting and non-adjusting events, and this standard talks about some disclosures. This standard talks about disclosures. This standard also talks about going concern and dividend related treatment. This standard talks about going concern and dividend related treatment, right? We will be covering it. And this standard is applicable. This standard is applicable in the accounting for and disclosure of events after the reporting period. So this standard bread and butter is account market has gone up. Okay. All investment has value has significantly gone up. Right? Right, my dear friends? So now the point is, my dear friends. So first of all, events after the reporting period can be favorable event as well as unfavorable event. Okay. It could be positive, it could be negative also. Okay. Favorable, unfavorable, which occurs between the end of the reporting period and the date when the financial statements are approved by the board of directors in case of a company and by the corresponding approving authority in case of any other entity for issue. Any event between the reporting date till the board approval, till the approval date, board meeting date, right? Any events which occur between the reporting date and the board approval, which is favorable and can be unfavorable also. Now, these events are defined as of two types, adjusting events and non-adjusting events. What is adjusting event? Let's discuss what is adjusting event. Adjusting events are those events which provide evidence of condition which existed on the end of the reporting date. Friends, adjusting events are those events which provide evidence of conditions which were existed on the reporting date at the end of the reporting date. Let me give you an example of unadjusting event, then I will discuss the example of adjusting event first. Friends, there was a fire in the warehouse, in the godown, in the factory of the company. There was a fire in the warehouse, in the godown, in the factory of the company, right? In the factory of the company on 15th of April, right? So whether the evidence of condition of this fire was available on 31st March. Yes, after 15 days, a fire will broke out in the warehouse of the company or factory of the company because somebody has put the kerosene matchbox, the transformer is nearby, or there is some switches, MC switch was there, the wiring was there. So whether evidence of condition was existing on the reporting date about the fire which was available, which broke out in the godown or the factory on 15th of April? Yeah, Manoj, Saminathan, Chitra, tell me whether evidence of condition of this fire was available, Sri Raman. Sri Raman, whether evidence of condition of this fire was available? No. Evidence of condition of this fire was not available. Right. Of course, Ravinder, you are absolutely right. आप क्या बोलोगे कि हाँ सर वहां पर किसी ने माचिस रखी थी, किसी ने केरोसिन ऑयल रखा था? No, evidence of condition was not available on the reporting date. Right. So it will be adjusting event or non-adjusting event? It will be a non-adjusting event. You are right, Saminathan. It will be a non-adjusting event. Right. So what are the adjusting event? Adjusting event are those events where evidence of condition was available on the reporting date. Right. Now, another example. The company is selling goods on credit basis. The company is selling goods on credit basis. If the company will sell goods on credit basis, the company may have a risk of, the company the company would have a risk of, the company would have a risk of kind of debt, bad debt. So Manish is asking, but due to faulty wiring, is it condition? No, no, Manish. You are you are talking about accounting, Manish. Even if the wire is faulty, is it is it known that on 15th April morning 10 a.m. the fire will broke out? And Manish, if the fire will broke out, why? Somebody will allow this fire to broke out. Just think judiciously, right? So you will not say, na, ki yes, sir. So the fire will, you will never say that, this evidence of condition because the wiring was there and company knows that on one fine day this arc will be there. The company never says that on one fine day this arc will be there, this fire will be there. No, no, right? So friends, this is a non-adjusting event. This is not an adjusting event. Now, second example, the company is selling goods on credit and there is a customer to whom the company has sold goods on credit and the customer was not paying since last 1 year. But of course, the company is selling goods in good faith. Now, the preparation of the financial statement, the audit started. The auditor asked for the balance confirmation from a customer, right? And when the auditor get the balance confirmation, when the company got the balance confirmation, the company found, when the company got the balance confirmation, the company found that this debtor was already bankrupt. This customer was already insolvent on 28th of February. On 28th of February. The company was not aware, but the debtor, the customer was already become bankrupt. My dear friends, whether evidence of condition of this bad debt was available on the reporting date or not, doesn't matter. Company was not able to know. But if the company would have inquired prior to 31st March on or before 31st March, whether this evidence was available or not, yes, evidence of bad debt, which was confirmed in in the month of April, it was available on the reporting date also. It was already bad on the reporting date also. So this is known as a adjusting event. This is known as a adjusting event, right? So friends, in this case, if the company has supplied goods worth 10 crore rupees to that customer and the company has shown a debtor of 10 crore rupees, okay, the company has shown a debtor of 10 crore rupees. My question is, this confirmation of debtor being bankrupt was available on, was provided on in the month of April. So whether this 10 crore rupees bad debt entry has to be taken in the next year or has to be taken on 31st March? Because it is adjusting event, and with the adjusting event, financial statement has to be adjusted. Tell me whether this 10 crore rupees of bad debt has to be taken in the 31st March itself or it has to be taken in the next year. You are absolutely right, Manish. It has to be taken in the 31st March because it is an adjusting event. So with the adjusting event, these event needs to be adjusted in the financial statement, right? Entity should adjust the amounts recognized in its financial statement to reflect adjusting events after the reporting period, and it can be favorable and unfavorable both. What could be the other example? Settlement after the reporting period of a court case that confirms that the entity had a present obligation at the end of the reporting period. Okay. The receipt of the information after the reporting period indicating that an asset was impaired at the end of the reporting period or that amount of previously recognized impairment loss of that asset needs to be adjusted, like bankruptcy of a customer. The determination after the reporting period of the cost of assets purchased or the proceeds from assets sold before the end of the reporting period. For example, you purchased some furniture from your friend's shop. You purchased a furniture from your friend's shop. Okay, from your friend's shop. Okay, now since it is your friend's shop and you went on 31st March and purchased the furniture, you asked what is the price. He told not to worry, कर लेंगे. आपके दोस्त ने बोला चिंता मत करो, कर लेंगे, right? So not to worry about the price, and he didn't told you about the price, or probably that furniture showroom dealer was your relative. So he told not to worry. He was your brother-in-law. He told not to worry. I will tell you when the time will come. Okay. Now, this asset was purchased before 31st March. The value of the purchase was not known. And when you pressurize him 5-6 times on 30th April before approval of the financial statement, he told you the value. See, this is the cost of the furniture. Friends, is it an adjusting event or non-adjusting event? Is it an adjusting event or non-adjusting event? It is an adjusting event, right? So you have already purchased the asset or sold the asset. The only thing is the value or the fair value. It was determinable later on. So you need to record the sale or purchase with that price on 31st March. Okay. So determination after the reporting period, the amount of profit sharing or bonus payment. For example, many companies are paying bonuses, which is profit linked, right? So like in my one of the old company, when I was working till 2015, in one of my company, they used to distribute the 10% of the profit among employees. They used to distribute 10% of the profit among employees, right? And generally what happens, friends? So when they need to distribute 10% of the profit among the employee, so first thing is you have to arrive at a profit. Friends, whether this profit is determinable on 31st March itself, क्या प्रॉफिट 31st मार्च को प्रॉफिट पता है हमें? Whether financial statements have been prepared on 31st March? No. Financial statements have not been prepared on 31st March. Profit is not available on 31st March. The profit made available when we completed the financial statement on 30th of April or let's say 5th of May. So when I completed my financial statement, I got the profit, then I take a provision entry of 10%. So the point is, when I'm saying that this 10% profit has to be distributed among employees as a bonus, whether this bonus provision has to be taken on 31st March or has to be taken in the next year, whether it is an adjusting event or a non-adjusting event, it is an adjusting event. It has to be taken on 31st March. Okay, right? Or you get to know the prior period error. You get to know the error, right? So basically, after 31st March, you are able to know that error has happened even in the current year. I mean to say this 31st March or the past year. So in that case, while you get to know after 31st March, but it will be treated as an adjusting event and you have to correct the error in the current year. Okay, itself. So these are the adjusting event. What is non-adjusting event? Very simple. The events which are not adjusting event is a non-adjusting events. So events where the condition arise after the reporting date. For example, fire in the godown. So whether the fire in the godown, whether the event of the fire in godown, whether this event arise after the reporting date or it arises before the reporting date it arises after the reporting date, right? It was not available on the reporting date. Okay. Another example. So, one example, we have taken a court case was going on and the settlement happened after the reporting date, and on 31st March, the evidence of condition says that yes, company, if there is a present obligation to the company. So whatever settlement have happened after the reporting date, but before approval of the financial statement, we have considered that settlement as adjusting event and we have adjusted our books of accounts. Now, you are absolutely right, Ravinder. Ravinder is saying which was not available on 31st March is non-adjusting. Am I right, sir? Ravinder, you are 5000% right. Now, my dear friends, there was a court case which started on 5th of April, right? There was a court case which was started on 5th of April and this court case was settled on 30th of April. Whether it will be an adjusting event. This court case was started on 5th of April and this court case was settled on 30th of April. Is it an adjusting event? Manish, on 31st March, whether
The evidence of condition was available on 31st March, Manish. No, it is not an adjusting event. This litigation started after 31st March, right? This litigation started after 31st March. It is a non-adjusting event. Okay, right? An entity should not adjust the amount recognized in the financial statement. So for non-adjusting event, the entity should not adjust the amount. What entity should do? They only need to disclose. They only need to disclose the non-adjusting event. They should not adjust. They should only disclose the non-adjusting event. And this non-adjusting event can be favorable as well as unfavorable. Can be favorable or unfavorable, both, right? Now examples. So many examples of non-adjusting event. Major business combination. Major business combination after the reporting date or disposal of a major subsidiary. A merger and acquisition or disposal of a subsidiary happened after 31st March. It happened after 31st March. Okay. It happened after 31st March, my dear friends. It happened after 31st March. So now the point is, it happened after 31st March. Some disposal of a subsidiary happened after 31st March, but before approval of the financial statement. So whether you will do the merger and acquisition accounting on 31st March? No, it was not there at that point of time. The merger acquisition accounting happens on the acquisition date. The disposal accounting happens on the disposal date. And these dates are afterwards, after 31st March. So friends, these are the non-adjusting event. But since it is a major acquisition, major disposal, it has to be disclosed in the notes to accounts. It is a non-adjusting event, only disclosure is required. Announcing a plan to discontinue an operation. So after reporting date, the company has announced that we will discontinue our operation in the state of Telangana, for example. So have they discontinued before 31st March? Or have they announced before 31st March? No. But since they have announced after 31st March and till the time you will get the result on 5th May, when Saminathan will get the result, whether Saminathan should be aware about this information or not, so that he will take a prudent decision whether he has to invest or not invest in this company. Yes or no? Yes, yes. And that is why this is a disclosure. This is a non-adjusting event, and hence disclosure is required. Okay. Adjustment is not required in the financial statement. Disclosure is required. Friends, have you understood the difference between adjusting and non-adjusting event? As the word suggests, adjusting event means your financial statement has to be adjusted with this event. As the word non-adjusting event suggests, your financial statement, no entry is required on 31st March. The disclosure is only required. Any challenge, my dear friends, in understanding this thing? Destruction of a major production plant by a fire after the reporting period. So there was a fire in the plant, godown, factory after the reporting period, and there was a huge loss due to the fire. Abnormally large changes. Abnormally, there are large changes. Okay. After the reporting period in asset prices or foreign exchange rates. Abnormally large changes after the reporting period in asset prices or foreign exchange rate. So you have a PP&E. After the reporting period, there are huge changes in the value of the PP&E, or there was a huge fluctuation in the market rates, foreign exchange rates, right? So friends, in this case, the disclosure is also required. Right? Disclosure is required means it is a non-adjusting event. It is happening after 31st March. Okay. So you have to take the value as on 31st March, not after that. Okay. Changes in tax rates or tax laws enacted or announced after reporting period that have a significant effect on current and deferred tax assets and liabilities, right? So basically, the Madam Nirmala Sitharaman has announced a new tax rate after the reporting date. So that will be considered as a non-adjusting event. Commencing major litigation arising solely out of events that occurred after the reporting date. So a litigation was started on 5th April, right? So this major litigation was started after the reporting period, occurred after the reporting period. In this case, my dear friends, it has to be considered as a non-adjusting event. Of course, it is a non-adjusting event because It is a non-adjusting event because the evidence of condition was not available on the reporting date. Okay. And major purchases of assets, classification of asset as a held for sale, so disposal, discontinued operation, if these are happening after reporting date, it will be considered as a non-adjusting event, right? And only disclosure is required, right? Clear? Is it clear or clear? So all these examples, sir, lottery winning would also be non-adjusting event. Yes, Rohan, if it is happening after reporting date, right? So if a company has won, and if company has won an award of 10 crore rupees by lottery on 5th of April, right? So whether it has to be an adjusting event, answer is no. This income never exists on 31st March. How can you adjust it, right? But of course, you want to tell to the shareholders, user of the financial statements, listen, I won 10 crore rupees, right? After 31st March, but before approval of the financial statement. Okay. Now let's talk about the special events. What is special events? Going concern. Have you read going concern by the mouth of Alok Garg in any standard recently? Whether Alok Garg has explained going concern in the recent standard in detail recently? Friends, किसी ने अभी गोइंग कंसर्न के बारे में पढ़ा है मेरे से रिसेंटली इन कॉन्सेप्चुअल फ्रेमवर्क? ओके रोहन, एनीवेयर एल्स? रोहन, एनीवेयर एल्स? एनीवेयर एल्स रोहन? Ind AS 1, you are absolutely right, Rohan. Ind AS 1. Ind AS 1, you are absolutely right, Rohan. Ind AS 1. Presentation of financial statement. And what is this going concern, Rohan, in Ind AS 1? What is this going concern in Ind AS 1? This is a general feature. This is a general feature of a financial statement. And what it says that financial statement has to be prepared on a going concern basis. And what is a going concern? When management foresee that the entity will able to continue as going, entity will be continue as going, right? It will be considered as a going concern, right? Entity will continue to operate, entity will continue to go, it will be considered as a going concern basis. In the foreseeable future means 12 months from the reporting date. What is meant by foreseeable future, my dear friends? Please write down. Foreseeable future means 12 months from the reporting date. 12 months from the reporting date. Now, the entity shall not prepare its financial statement on a going concern basis if there are three conditions which will met. We read in Ind AS 1. So an entity shall not prepare its financial statement on a going concern basis if entity has an intention to liquidate, if entity has already ceased trading, or entity does not have any alternative but to liquidate the business. Okay. Sir, if this is happening during the year, the entity has already started discontinuing the business, or the entity has an intention to stop the business, or entity does not have any alternative except to shut down the business. During the year this has happened. But my dear friends, tell me one thing. Sir, if it is happening on or before 31st March, it is okay, it is covered under Ind AS 1. Sir, what happens? Due to a major fire, all the assets and the lines of the entity was destroyed, and the directors was not decided about the fate of the company, and the management feels that the going concern is impacted. And this happened on 15th April. On 31st March, the company was full, sound, rich, having a huge order in hand. The company was a $1 billion company, cash rich company on 31st March. But due to a fire on 15th of April, the company destroyed everything. Now the company is not able to survive. The company is thinking that we will not be able to survive in future. We will not be able to survive in the foreseeable future. Friends, on 31st March, whether evidence of condition was available for this going concern impact? No, because evidence of fire was not available. सब कुछ ठीक था 31st मार्च को, 15th अप्रैल को गोइंग कंसर्न का इंपैक्ट आ गया. So friends, whether this impact of going concern will be treated as an adjusting event or non-adjusting event. क्या माना जाएगा? एडजस्टिंग इवेंट माना जाएगा या नॉन एडजस्टिंग इवेंट माना जाएगा? If I will tell you, going by the guidance of evidence of condition was not available on the reporting date, it is a non-adjusting event. But my dear friends, why it is qualified as a special event? Why we are discussing this as a special event, not as a example of adjusting or non-adjusting? Friends, standard says that this is an exception. This is an exception. And what is an exception? While this going concern could be a non-adjusting event, but while it is happening after the reporting date, but it will be treated as an adjusting event, right? And your 31st March financial statement will not be prepared on a going concern basis. Is that clear? Is that clear? Is that clear? Not clear? Yes. So now let's write down a question so that it will be there for you always. Question. A Limited is a cash-rich company with a huge orders in hand. Okay. A Limited is a cash-rich company, with a huge orders in hand. So they have an amazing performance for FY 25-26 and expecting a huge profits. Unfortunately, a fire was broke out in the premises of the company and destroyed all the inventories, plant and machinery, and accounting records. While the evidence of condition of this fire was not available on 31st March 2026. The management is not sure about the continuity of the company. Suggest whether financial statement for the year ended 31st March 2026 will be prepared on going concern basis or some other basis, right? What is your answer? On some other basis like liquidation basis or realizable basis, right? Answer. While evidence of condition of going concern was not available on 31st March, but going by the principle of Ind AS 10, this has to be treated as an adjusting event and the financial statement statement has to be adjusted by taking the impact and should not be prepared on a going concern basis. Okay, right? So whenever you read this Excel file, you will be able to know this. Rohan is saying this should be prepared as per liquidation basis because going concern affected by an event after reporting date. Yes, you are right. You are absolutely right. Now the second example, second special event is dividend. So friends, dividend declared after the end of the reporting period. Dividend declared after the end of the reporting period. Manoj is saying, sir, they have the insurance policy and case in court. How we will deal in this case, sir? So insurance policy for this fire, Manoj. Insurance policy for this fire. Yeah. Okay. So Manoj, in that case, you have to see when you're talking about our insurance now. So it is like a contingent asset. So your loss has already happened. So you have to record the loss on a conservative basis because it has incurred. But when you talk about insurance policy, you have to look with respect to whether there is a virtual certainty that the insurance claim will be received. Surveyor will come, the surveyor will assess it. If it is reasonable certain that the insurance claim will receive and the company will be able to demonstrate that yes, we will come back in the operations in 1 year. In that case, it will not be, in that case, the financial statement will be prepared on a going concern, but the note has to be given respect to the material uncertainty relating to going concern. Okay, the note has to be given, right? Clear, Manoj? Clear, Manoj? So a note has to be given stating all the facts and circumstances. This is the amount of the loss. This is the money which we are virtually certain that it will be received. Okay, with respect to this event. And if that will not be received, then of course our going concern will be jeopardized. So all these facts, all these things are required to be disclosed. Okay, right? Dividend, friends. Many of you have seen in the final results of the company. Just say all these big listed companies, they are coming with their annual results in the month of April, in the month of May, right? They are coming with the results in the month of April and May. Okay. So friends, when they are coming with the result in the month of the April and May and they write, for example, a listed company, let's say, Reliance Industries Limited. Reliance Industries Limited in the annual results in the month of April, they have declared a dividend. Okay. And they told that this is a final dividend relating to the year 2025-26. In their board meeting, they said, this is the financial results, okay, for the year 25-26, and they have declared the final dividend with respect to 25-26. So whether this dividend entry we need to take on 31st March or this dividend entry has to be in the current year in which it was declared. Friends, this dividend evidence of condition was not available on 31st March that the director will declare the dividend on 5th of May or 30th of April. No, right? So dividend declared after the end of the reporting period are not recognized as these are non-adjusting event, right? So dividend declare has to be non-adjusting event, even though your question will tell you that this dividend pertains to final dividend pertains to 25-26. Still, it has to be the accounting entry has to be taken on the date of declaration in the current year only. Is that clear? Yes or no? Yes. Now, what are the disclosures which are required? The disclosure is date of approval for issue. Friends, when the financial statements have been approved and who has approved the financial statement. For example, when you read the Infosys annual report, you will find they write the annual report of Infosys, not annual report, the financial statement of Infosys Limited has been approved. The financial statement of Infosys Limited, has been approved, right? On 11th of April 2026. Why did meeting dated 11th April 2026 by the board of directors? Okay, right? So these things are required to be disclosed, and an entity shall disclose the following for each material category of non-adjusting item. For non-adjusting event, the entity has to disclose the nature of the event and an estimate of the financial effect or a statement if the effect cannot be made, right? These are the disclosures. Now, my dear friends, quickly check your knowledge on adjusting, non-adjusting event. Which of the following events are going to be adjusting and which are non-adjusting? Reporting date is 31st March. You have to tell me which is an adjusting event, which is a non-adjusting event. Significant disposal of a subsidiary, major subsidiary, which happened after balance sheet date and it took place in the month of May, right? The gain on disposal was 20 million, adjusting or non-adjusting? The major acquisition, disposal, it has to be treated as a non-adjusting event, right? Management board took decision on 30th March to dispose significant part of business and announce its plan on 28th May. Adjusting, non-adjusting? Many students are saying non-adjusting. Friends, while Manoj is saying adjusting, Manoj, have you read Ind AS 37? I think not yet, right? Have you covered Ind AS 37? Provisions, contingent liability, contingent asset. That is why you are saying adjusting, and Ravinder, you are saying adjusting, and many students are saying non-adjusting. Let me tell you, there are two type of obligation: contractual obligation and constructive obligation. Constructive obligation comes into the picture when you announce a decision, right? So here on 30th of March, the board itself just take the information in its pocket, approve it, but announce the plan on 28th of May. So friends, since the plan has not been announced prior to 31st March, and hence it will be considered as a non-adjusting event, right? Because the constructive obligation exists on after 31st March, right? Clear, Manoj? Okay. So this concept requires a knowledge of Ind AS 37 also. That is why it will be considered as a non-adjusting event. Third, so Manoj, board minute mein they only decided. They only took a decision. They have not implemented it. I mean to say it will be considered as a constructive obligation when the plan was announced and communicated to the affected parties. To the affected parties, right? To the affected parties. Okay. Clear? Clear, my dear friends? The company had marketable investment, the value of which deteriorated as a result of global crisis which started in May. On 31st March, the value was super, but the stock market has just gone down because of the global crisis in the month of May. Whether it will be considered as an adjusting event or non-adjusting event. While there is, due to global crisis, there is a huge decline in the value of the investment, you have to disclose. But whether the May month value you will take in the month of March, no, it is a non-adjusting event. It is a non-adjusting event, right? Now, please read this question with a patience. As of 15th April, a major fire took place and significant portion of asset is now impaired. Significant portion of asset is now impaired. It caused a significant disruption in daily activity and a loss of currency 12 million of asset in book value terms, right? The company will need to borrow new funds to restore its operating capacity. So the company can borrow and the company can restore the fund, right? Due to the fire, the significant portion is impaired, significant disruption was there, loss was there, but the company will need to borrow new funds. So company has an open credit line, the company will be able to get the funds and the company will restore the operating capacity. Adjusting, non-adjusting? It will be non-adjusting or adjusting? It will be non-adjusting because it is not impacting your going concern. It will be a non-adjusting event, right? It is not impacting your going concern, right? Okay. Now, fifth question. A major fire post-reporting date destroyed most of the company's assets. All production lines are no longer operative. To date, the company could not borrow new funds to restore the operating capacity. The director have not yet decided about the future of the company, means major issue. Friends, adjusting event, non-adjusting event? In this case, it will be like a impact on the going concern. It will be adjusting events. It will be adjusting events, right? Now, next. After balance sheet date, but before the date of authorization of the financial statement. After reporting date, but before approval of the financial statement, as a result of court decision, the company had to pay a compensation to one of its customer for faulty operation of the product which was sold to that customer in December. After balance sheet date but before the date of authorization financial statement, as a result of court decision, the company had to pay a compensation. Means on 31st March, this litigation was there. The company had to pay a compensation for one of the customer for selling a faulty product in the month of December. Adjusting or non-adjusting? Friends, condition exists as on the reporting date. Adjusting event. 7. One of the employee died as a result of food poisoning during work sometime in the month of April. One of the employee died as a result of food poisoning during work sometime in the month of April. On 28 June, the court decided that the company was liable of the food poisoning. So it was started in June and it was started in April, right? This employee died in the month of April after March. And in the June, the court decided that it was due to food poisoning and awarded 1 million compensation to the widow of that employee. Whether that will be considered adjusting event, non-adjusting event. Whether this condition was available on the reporting date. This employee died in the month of April only. It was not available on March. Yes, it is a non-adjusting event. Friends, have you understood the meaning of event occurring after reporting date? Have you understood the meaning of adjusting event, example of adjusting event, meaning of non-adjusting event, example of non-adjusting event, a special event in case of going concern, dividend, right? And with the help of these 7 questions, and these kind of questions are there in your case study also. So friends, these are about Ind AS 10. Very simple difference between Ind AS and AS. In Ind AS it is 10, in AS it is 4. And if there is a material non-adjusting event in Ind AS, it has to be disclosed in the financial statement notes to accounts. But in accounting standard for non-adjusting event, disclosure is not required in the financial statement. Disclosure is required in the board report, board of directors report, right? And this is your thank you slide. Friends, we have covered Ind AS 10 and Ind AS 8 in detail, right? I will share this PPT and the Word and the Excel file with all of you, right? I hope you have enjoyed the session and thank you for the birthday wishes, right? Thank you so much. Stay safe, stay happy. Bye-bye. Take care. Thanks, Ravinder. Thanks for all your wonderful feedback, right? Thank you so much. I hope you have enjoyed the session, right? Let's meet in the next class. Bye. Take care. Yeah, session is over, man.